earning per share in this video. So earning per share is actually very simple. If using a normal finance logic, if we take the profit attributable to owner equities, so meaning to say this profit is after your preference share dividends that retained for your ordinary shareholders divided by number of shares. It is very simple. If today your profit attributable to equity is actually 100,000, and your number of share is 120,000 units, so if you divided it, you are going to get 0.83 cent. However, when we are dealing with IAS 33, we are looking at weighted average number of shares. Meaning to say, there are certain period you are holding different level of shares. Therefore, you will need to calculate how many months you have that particular amount of shares, and you need to adding it up for the whole year. So earning per share is actually telling us today 1 unit of shares that you buy, how much earning you can actually get from that company. So let's using this example to explain the basic things that you need to know for IAS 33. So IAS 33, there are multiple types of issue. So in general, I can actually conclude that there are two types of calculation. One is basic EPS. And we are calculating basic EPS. There are few items you need to take note. First will be your issue of new shares. So this is a very typical example. Like in normal time you issue the share to your shareholders, and for sure your number of shares is going to increase. So this is the most common example. Another one will be the bonus issue, whereby you issue share at a free price, meaning to say you actually give the free shares to the shareholders. This is actually a form of kind of a dividend without paying cash. You are still retaining the cash, but you give shares instead. Third will be the right issue, whereby you are issuing shares at the discounted price. So these three things is particularly will affect your basic EPS in a very simple scenario. Now, the second calculations that involve here is called diluted EPS. So this diluted EPS, meaning to say we are actually doing a how if analysis. Currently, if let's say you have a convertible loan, this convertible loan is going to convert in future become your shares. So you would like to stimulate to your investor for them to know if this convertible loan or options become your shares now, what is the likelihood of the impact that you can see in the basic EPS. So it is a how if analysis. So if let's say you saw convertible debenture or loan or options to director or employee, something that might be converted into share in future, then this will touch your diluted EPS, and you will need to take note and do calculations for diluted EPS. So to explain this in deep, let's look at this example. So this example, we have 2 year end. We are required to calculate 2 year ends EPS, basic EPS and diluted EPS, if any. So first, assuming 1st of January, the company has 450k of ordinary shares. So 450k of ordinary shares. So we are going to start off with 1st of January. So this is 1st of January. And we will start with this timeline. And after that, we happens here with 1st April 26, you do a bonus issue. So this bonus issue is 1 for 5. for 5 existing shares, you will get a new shares for 1 unit. So 1st of April. And after that, somewhere around October 1st, you have actually issue new share. So issue new share of 50k. So this will touch on our 2026 year end as well. So somewhere around here, we close our account. So somewhere around here, we close our account. So this is 1 year end. So we close our account in 31st December 26. So we start off with the new financial year. So new financial year is cut off with 31st December 2027 and continue 1st April 2027 somewhere around here. 1st April somewhere around here, we do a right issue. So this right issue is actually first 1 new shares from 4 old shares, and this old shares and this right issue is actually at 2 ringgit. So meaning to say you make a discount at 1 ringgit and 50 cent, and the shares before you right issue is actually worth 2 ringgit. So around here, RM2 ringgit is the fair value. So it's the fair value is 2 ringgit, RM2 ringgit before you right issue. So all this we put it the information first for us to easy analyze later. And in July, so somewhere around here in July, you actually have issue convertible loan. If you can, please highlight in your rent convertible loan is related to your diluted EPS. So convertible loan, and this convertible loan is 150k to be converted. From every 150 you can convert into 50 shares, and the interest associated with the loan is 4%. So this one I will put it in red color for me to remind that this is a diluted EPS item. So we are ready for all these items, and the question tells you the year end we have profit attributable to equity on this date is 456,000, on this date is 533,000. This is the profit attributable to equity that we are going to use to divide against our weighted average number of shares. And you have the basic EPS in 2025, meaning this last year, you have to do an adjustment, a retrospectively adjustment to restate the EPS. And both years tax rate is 24%. So let us start with the first year. So first year in here, from 1st of January until, from 1st of January until 1st of April, you have 4 months. Sorry, you have 3 months. So you will need to take note of how many months you have. And from this period to this period, you actually have April, May, June, July, August, September, September until September, so 6 months. Again, April, May, June, July, August, September, 6 months. So obviously here is 3 months. So same things. Okay, let me just drag this one up. Here, from the date you actually start with the account until the date you write issue, which is 1st of April. Let me write here, 1st of April, is actually 3 months as well. So from this date, 1st of April, until you convert the loan, okay? But anyway, convert loan is actually related to diluted EPS. So if let's say we are talking about basic EPS, meaning to say this one we won't touch it. So we just put here 150k, okay? And this remaining is 9 months for us to calculate our basic EPS. Later for diluted EPS is from let me check. It's from 1st of July. So 1st of July, August, September, October, November, December, 6 months. So the diluted EPS is 6 months. So it's 6 months. Later we will apportion by 6 months. So let's start with weighted average number of share 1 at 31st December 2026. Let's calculate this. So from 1st of January 2026 until 1st of April 2026, this period you will need to calculate by using 450k by right times 3 divided by 12. But IAS 33 specifically say that if let's say during the year you have a right issue, before here you haven't do any right issue, you still need to retrospectively adjust it. You need to treat it like it happened for the whole year. So we will need to include this bonus fraction from the bonus issue into this period as well, because this bonus issue is actually attached in the old share. Without the 5 old share, you cannot get the bonus issue. Therefore, we assume that in this period you also have the bonus issue impact. So we will times because you have every 5 old share you will get the new 1 share. Therefore, in total you will get 6 shares after bonus issue, and I divided by times 6 divided by 5. Then only I times with the time apportionment. So this is very important because we call it as retrospectively adjustment. We treat it like it happened also in the first 3 years. This is required by IAS 33. And therefore with that, 450 times 6 divided by 5 times 3 divided by 12, you will get number of shares at 350 shares at 135 from this period. Then from 1st of April 26 until 1st of October 26, we are going to use 450k as well times 6 divided by 5. This is the period that you already bonus issue. Okay, so we can directly use times 6 divided by 5, and we will times 6 divided by 12 because it's 6 months for this period. So same things, times 6 divided by 12. We will need to present it in 2 lines, even though the basis of bonus fractions is the same, because we need to show the examiner that we know that this is retrospectively adjustment, this is a real adjustment when the bonus issue happened. And from 1st of October 26 until 31st December 26, so this period is where 450k times 6 divided by 5, then again you need to plus the 50k new issue, then only you times 3 divided by 12. So this is after you bonus issue already, then you issue additional share, and this period of shares you hold for 3 months, so I times 3 divided by 12. So the formula will be 450 times 6 divided by 5, then you plus 50. So you have this much of shares, 590. But then you need to times 3 divided by 12. So the share unit will be this much. And you sum it up, that will be your 1 NOS. 1 NOS at the end of the year. So you get your 1 NOS, basic EPS, you can calculate it using this formula. We are going to use profit attributable to equity, and we will divide it against our 1 NOS. So we will divide it against our 1 NOS. So the amount of answer is, okay, for the year end 2026, you have 456. And this is your 1 NOS. But of course, because our denominator, we actually putting it at the number of decimal point, so we will need to use 456 divided by this, and you will get your basic EPS at 82 cents. So this is for basic EPS for the year 2026. But after you do this, you will need to do a reinstatement of 2025 as well. 2025. So since bonus issue increase one-offs will dilute your EPS, will reduce your EPS. Last year you have 0.9 cent. You will need to factor the bonus issue as well. So the bonus issue, just now you inflate because you want to calculate one-offs. Now you want to take in the one-offs factors that will reduce your EPS. In this case, I will times 5 divided by 6 instead. Here, times 6 divided by 5 because you want to inflate the number of one-offs and you reduce the EPS here. Here, they directly give you EPS. So you need to reduce because when bonus issue happen, your EPS will reduce. So we discounted by times 5 divided by 6. So 0.9 times 5 divided by 6, you will get 0.75. So this is the answer. You compare. So after you compare, you can conclude that, okay, 2026 performance still better because still higher than 2025 after you inflate, after you adjust with the reinstatement impact. So this is the answer for 2026. And after you do that, we will need to do 2027. So 2027, there will be slightly things that you need to do before we calculate one loss. So our one loss is actually quite straightforward for 2027. So before we start with 2027, we need to know at the opening what is our ordinary share opening. So technically very simple. So this ordinary share of your opening, right, we can actually calculate by using 450k at the beginning times 6 divided by 5, inflate by the bonus issue, and we times, and we need to plus with the 50k. So this is not weighted average because we need to know accumulate until this date what is the starting. So using this formula, you know the starting will be 450 times 6 divided by 5 plus 50. The starting will be 590 ordinary share on this date. So your ordinary shares is 590k. So once we know already, we got right issue. Then convertible loan won't touch your basic EPS. So in short, we will start from 1st of January 2027 until 1st of April 2027. This is the period before the right issue. And after the right issue will be 1st of April 27 until 31st December 27. So just like that. To calculate this period, meaning to say over here after your right issue, is very simple because you just need to take your starting 590k times inflate with the right issue impact. So for O share, you are able to get 1 unit for right issue. So after you inflate will be 5 divided by 4 and times 9 divided by 12 because you hold for 9 months. So this is your at the end of the period, which is the last 9 months. We haven't calculated the first 3 months. First 3 months is involve more calculations. So we calculate this first, 590 times 5 divided by 4 and times 9 divided by 12 for 9 months. So I get 553. But in here, right, we have this happening in here. So this period that I put it in the dark pink color, okay, so this dark pink color, right, it will be require some adjustment, and you will need to factor this right issue bonus fractions into this period as well, because without having the O share you cannot get the right issue. But right issue is a discounted shares. It's not like bonus issue that is totally free where you can just times 6 divided by 5. In here, you will need to calculate a thing called theoretical X right price. Theoretical X right price. I will just put short form because I don't have space. So to do this theoretical X right price is actually telling us the O shares with the benefit of right issue and before the right issue, what is the price of the shares? So in here, let's follow me closely. New share is 1 unit. So 1 unit of new shares, you will sell at 1 ringgit and 50 cent. You will plus with the old shares you have, which is 4 unit, and you will times with the old share previously before issue sell at 2 ringgit. And here only you will divide it by, and here only you are going to divide it by total share. You have 1 new one plus 4, which is the old one. So total is 5. So to do this, let's do it. 1 times 1.5 plus 4 times 2, and we will divide it by 5. So we can conclude that before the right issue, the share per unit is actually worth 1 ringgit 90 cent, including the right issue impact. So this is your so-called the average price before the right issue, which is 1 ringgit 90 cent. So this is important because we are going to use this in our calculations. We start with 590k ordinary share starting, and we will times the shares before we issue, the market price 2 ringgit divided by 1.9. So this is important. This is coming from 1 ringgit 90 cent here, and only we will times 3 divided by 12. So this is so-called the bonus fractions. We are trying to tell them how much is the benefit being in flat. Because market sell at 2, your theoretical XY price, meaning the share before you write issue, your share is actually worth how much? 1 ringgit 90 cent. So the difference of 0.1 is the free benefit which will inflate your shares. So we will need to use 590 times 2 divided by 1.9 and times 3 divided by 12. So this will be your weighted average for 3 months. And we aggregate it up and we will get 708. So this 708, again, I apply with this basic EPS. So my profit attributable to equity according to the question is 533 for 2027. So 533 for 2027, and one nose is this one, and I divide. I will get 0.75 cents. Please put the unit 0.75 RM or 75 cents. Okay, this is RM. So with that, this is this year 0.75 cent. Of course, based on this is 2027, you also need to adjust with last year 2026. You need to tell us if this right issue impact also factor in 2026, how much is the diluted EPS and how much is the EPS of 2026 after you restated. So this is restated. So restated with the impact of right issue. So you will start off with 0.83 that you calculated last year, and you need to times. Just now it's times 2 divided by 1.9. Now it's times 1.9 divided by 2 because we want to discount it with how much it inflate. So after that, 0.83 times 1.9 divided by 2, and if let's say this right issue happened in last year, it will be from 0.83 become 0.79. So can you see, comparing both with the right issue impact, 2027 having a serious reduce in EPS. So we are trying to tell this to the shareholders and investors. Not to forget, we will have our diluted EPS. So diluted EPS is actually, because it's coming in 2027, so only impact 2027, the convertible loan. So diluted EPS. So diluted EPS, we will need to use profit attributable to equity plus any interest saving after tax, after you pay your tax. After tax, so you need to pay any tax that you need to pay for your interest saving. And the one-offs, original one-offs here, you need to add any potential increase in your shares. So you will need to calculate your interest saving after tax. So the loan here is 150k, and based on the question, they say interest associated interest from this loan is 4%. So I'm going to times 4%, and I will times 6 months because happened for 6 months divided by 12. Not yet end. The most important part is you will need to pay tax. So this interest is an income, saving is an income. You will need to pay 24% tax. So which means the retaining interest income after you pay tax is actually 76%, because 100% minus 24, you retain 76%. So you need to times 76. So your interest in this case will be 4% times 6.6 divided by 2 times 76%. So your interest will be 2.28, and this is your interest saving. At the same time, potential increase. The potential increase, I'm start off with 150k because it's a convertible loan, and they say every 150 you will get 50 shares. So I will divide 150 and I will times with 20 shares. Let me check. 50 shares, sorry. 50 shares. Then I will get it, and times 6 divided by 12 because happened for 6 months. But bear in mind, you can times 50 divided by 150 is the same. So 150k divided by 150 and times 50 times 6 divided by 12. So this one, because I'm using the denominator of 1000, so let me just convert it into 1000. So we are going to increase by 25,000 of shares. So with that, we will incorporate our basic EPS by using this 533 plus my 2.28 interest saving, and I will start off with 708.39 plus my interest, the potential increase 25,000. So following this, let's calculate our diluted EPS. That will be 533 plus 2.28, and we will divide it by 708.39 plus 25, and your diluted EPS will be 0.73. So meaning to say, we are trying to tell investor, before this convertible loan happened, your EPS is 0.75. After, assume we convert this right now in here, your EPS will be 0.37. So this is diluted EPS. What does it mean? So therefore, we have covered the basic EPS, diluted EPS for the entire questions for this example. Thank you.